The next topic, as you can see, is regulatory framework in economic capital, and it is the final one topic of the course. So let's go on. So first of all, let's get back to the history and evolution of the banking regulation, focusing on the Basel Committee and its recommendations. So as you can remember from the introductory lecture, the first one, so I said a few words about that. The regulation of financial activities is really crucial, is really important, and has become really important over the past few decades in the global financial system, and it has become more and more complex and interconnected, I would say. So let us look at the major economic events and crises. Those have shaped regulatory approaches over time. So first of all, let's consider the history of the Basel Committee on Banking Supervision. As you can see here in the slide and the timeline, the formation of the Basel Committee was a direct response to, I would say, turbulent economic events in the early 1970s. For example, in 1971, we saw the collapse of the Bretton Woods system of the fixed exchange rates. And this led to the so-called free floating of exchange rates in almost 1973, and also the rise of the currency trading as a major, one of the major financial activity. And the key catalyst here was in 1974, which was the bankruptcy of Herstatt Bank in Germany. Because why it is important? Because despite being only the fourth largest bank in Germany by assets, so its collapse had a really significant ripple effect on the global financial system. And this highlighted the need for international coordination on banking supervision. And in response, the central bank governors of the G10 countries established the Basel Committee on Banking Supervision in the same 1974. So then the committee held its first meeting on February 1975, and it made the beginning of the new era, actually, in international financial regulation. And over the past 50 years, the Basel Committee has become the primary global standard setter for banking regulation, and its recommendations have shaped really financial policy worldwide. So then, today, the Basel Committee remains the international center for developing standards in banking regulation and supervision, and in general, its main objectives are threefold. First one is implement uniform standards for banking regulation globally, then ensure the reliability and stability of the international banking system, and finally, increase competitiveness between international operating banks. And the committee has expanded actually significantly since its foundation. Now it includes for about 28 jurisdictions representing major banking sectors around the world. And the committee meets 4 times a year to discuss and develop regulatory standards. And over its history, there is an interesting fact that the committee has produced more than 500 documents providing guidance and recommendations. So this graph here on the slide illustrates the relationship between major economic events, banking crisis, and regulatory responses over the past 40 years. Here, The blue bars show bank failures in the US, while the orange line tracks the S&P 500 stock index. Here, not the orange, but the gray one. Yeah. This index, as you know, a key indicator of overall economic health. Here we can see several major spikes in bank failures corresponding to economic downturns. The first one of them is the savings and loan crisis in the late 1980s, then the recession of the early 1990s, the dot-com bubble burst, recession in the early 2000s, then and more dramatically, the 2008 global financial crisis. And I would say that each of these crises prompted regulatory responses, which we see noted along the bottom here. And Basel I actually was introduced in 1988, and it set the first international standards for the bank capital requirements. Basel II came in 2004, aiming to improve the Basel I by allowing banks to use internal models for the risk assessment. And Basel III here was a direct response to 2008 crisis, and it significantly strengthened capital and liquidity requirements. And finally, Basel IV, which refined the standards also. So now let's examine the how the Basel Accords have evolved from the Basel I to the current Basel IV framework. The first one, as you can see here, the Basel I. So the primary goal was to ensure a minimum level of financial stability for the banks. And then it focused mainly on credit risk with the very simple capital requirements, as for 4% Tier 1 capital and 8% of total capital required to cover on the risk. And Basel II aimed to stimulate improvement in the bank's risk management culture. It introduced the three-pillar approach, for example, minimum capital requirements, supervisory review, and market discipline. And it allowed banks to use internal models for calculating capital requirements. And Basel III was developed in response to the 2008 crisis, and it aimed to ensure stability of the entire financial system. It really introduced changes to capital structure, requiring high quality capital. For example, Tier 1 became more than 5.5% burden and of the risk-weighted assets for sure. And it added capital buffers, and it added new liquidity requirements. And Basel IV mainly focuses on reducing systematic risk. It introduces constraints on the use of internal models, and it includes post-crisis measures like TLAC, which means total loss absorbing capacity. So this timeline compares the implementation of the Basel standards in the European Union and Russia. As you can see here, Russia has generally lagged behind the European Union in adopting financial standards, but has been catching up in recent years. And key milestones for Russia were Basel I was implemented in 1997, nearly a decade after its international introduction. Basel II and 2.5 as well were implemented simultaneously in 2015. And Basel III implementation began in 2013. And the European Union, by comparison, has the quicker adoption of the new standards. For example, it has adopted the Basel II standards in 2008 and Basel III in 2013. Oh, sorry. So the current Basel framework is built on the three-component model, which is often referred to as three pillars. And here, as you can see, the pillar one means minimum capital and liquidity requirements, and it sets the quantitative standards for the bank capacity of bearing the proper capital and liquidity. And it also includes requirements for credit, market, and operational risk. Key metrics here include capital adequacy ratio, a leverage ratio, liquidity coverage ratio, LCR, and also net stable funding ratio, NSFR. And here, pillar two means supervisory review process, and it focuses on the qualitative aspects of risk management. It usually requires banks to have internal processes for assessing capital adequacy. It also empowers supervisors to review and to evaluate these processes. And key elements include here stress testing, risk appetite frameworks, and also capital planning. And the final pillar three means market discipline. This pillar aims to complement the first two by promoting transparency. It sets disclosure requirements for banks regarding their risk profile, regarding their capital structure, risk management practices. And here, the goal is to allow market participants to assess a bank's risk position accurately. So altogether, these three components create a comprehensive framework for the bank's regulation and supervision as well. So let's start by examining the first component of the Basel framework, the minimum capital requirements. Here, the core concept is capital adequacy, which ensures that banks have sufficient capital to absorb potential losses. And capital here is divided into tiers based on its quality and performance. First is tier one capital, which is the highest quality, and it consists of the common equity tier one or CET1, which includes mainly common stock and retained earnings. Then additional tier one, which includes items like perpetual, subordinated debt, for example. Then tier two capital, which is supplementary capital, including items like term subordinated debt, for example. Then here, the key metric is capital adequacy ratio, which is calculated as a percentage of the risk-weighted assets. Tier one capital must be at least 4.5% of risk-weighted assets. Total tier one capital must be at least 6%, and total capital, that is tier one plus tier two, must be at least 8% of the risk-weighted assets overall. And here, risk-weighted assets is a measure that adjusts the bank's assets based on their risk level. So it's usually calculated for credit, for market and operational risk. So here you can see three main approaches to calculating risk-weighted assets for credit risk under Basel II and III. First of all, a standardized approach, then foundation internal ratings-based approach, and the final one is advanced internal ratings-based approach. All of these approaches represent a spectrum from simple and standardized to complex and bank-specific ones. So, for example, standardized approach, it uses fixed risk weights set by the regulators. It's simple, but less risk sensitive. Then foundation IRB means that banks estimate probability of default using internal models, and regulators provide other risk components like LGD and exposure default. And according to advanced IRB, banks estimate all risk components, that is PD, LGD, and exposure default using internal models. Most risk sensitive, but it is most risk sensitive, but requires sophisticated risk management systems. And as we move from standardized to advanced IRB, then capital requirements generally decrease on average, but requirements for risk management systems increase significantly. And finally, the choice of the approach depends generally on the bank's size, on the bank's complexity and risk management capacities as well. But regulators must approve the bank's use of internal models before it can use it. The internal ratings-based approach is really a cornerstone of the modern credit risk management under Basel III, because it allows banks to use their own internal models to estimate key risk parameters like PD, LGD, and exposure default. And the IRB approach here is integrated throughout the credit life cycle. And as you can see here, at loan issuance, models are used to assess risk and price loans. Then during monitoring, regular updates of ratings and collateral valuations are performed. Then for problem assets, it is used in default identification recovery processes, and for the key requirements of IRB implementation may be data quality, which means robust historical data on defaults, recoveries, collateral. Then model development and validation, which means usually rigorous statistical modeling and testing. It is used in processes in the following ways, like, for example, models must be integrated into day-to-day risk management, and governance, strong oversight, and control processes are in place. Regulatory improvement is required for the IRB approaches. And this slide illustrates really how risk-weighted assets are calculated for credit risk under the IRB approach. As you can see here in the slide, the process starts with the bank's balance sheet and off-balance sheet as well in terms of exposures. And for off-balance sheet items, a credit conversion factor is applied usually to convert the loans or the exposure to a non-balance sheet equivalent. Then the key risk parameters are here applied, the following, like PD, LGD, AD, and M, which means effective maturity. And all these parameters are inputs to a regulatory formula that produces a risk weight for each exposure. And the formula here is designed to capture unexpected losses. And you should remember that hereby expected losses are covered by provisions. One of the applications of the internals-based risk model is risk-based pricing, which actually is a key application of this. And the process typically involves estimated expected losses using PD, LGD, and exposure default, calculating capital requirements based on expected losses, determining the cost of capital, add an operational cost and desired profit margin. And the result of all of this is a minimum interest rate that should be charged to cover all costs and risks. And benefits of risk-based pricing here is in that it's more accurate reflection of risk in loans terms. It has improved risk-adjusted profitability. It has better alignment of pricing with the bank's risk appetite, and the main challenges include complexity of calculations, need for frequent updates as risk parameters change, balancing risk-based pricing with market competitiveness, and so on. So, and here, IPC stands for International Procedures for Capital Adequacy Assessment, and this is a crucial part of the Part 2 of the Basel framework. The IPC process here involves several key elements, like, for example, corporate governance, like risk appetite, like risk identification, like strategic planning as well, stress testing, documentation, and so on. And the final component of the Basel Accord is market discipline, which is a third pillar. And key aspects of this part in terms of disclosure requirements include what to disclose, frequency of disclosure, where to disclose. The goal is to provide here the market participants with the sufficient information to assess the bank's risk profile and capital adequacy. So, and this actually creates an additional layer of oversight beyond regulatory supervision. But it has also a few challenges, including balance and transparency with confidentiality, like ensuring disclosures being meaningful and not just a data dump, and maintaining consistency and comparability across banks as well. So the next item is ICAP, or Internal Capital Adequacy Assessment Process, which is a key component of the Pillar 2 of the Basel III Accord. It requires banks to have an internal process for assessing their overall capital adequacy in relation to their risk profile. And for example, the Central Bank of Russia has actually developed its own methodological recommendations for ICAP based on Basel III and on the global best practices. So ICAP actually goes beyond regulatory capital requirements because it considers all material risks and bank faces. Not only market, credit, or operational, for example, as in Basel II Accord. So it's a forward-looking process. It considers the bank's strategic plans, and it considers potential future risks as well. So, and as it was said before, risk-weighted assets is a very important concept of the Basel Accord. So, let us consider once again in a more detailed way different approaches to the credit risk-weighted assets calculation. So RWA here under the credit risk is calculated on the scheme of various risk-weighted asset categories, which are determined by the risk profile of the borrower or, for example, counterparty. And the risk ratios here, or risk weights, in other words, are fixed by Basel III, and they are focused on the rating of the borrower and counterparty. And unlike the internal models approach, the standardized approach does not require the development of complex internal assessment models because it relies preferably on the regulator defined risk weights. So the next one is foundation internal ratings based approach. So, and here under this method, the RWA calculation is based on Basel III formulas provided by the regulators. And here, the probability of default usually is determined using the bank's own internal statistical models for credit rating, for example, and scoring. But loss given default and exposure default parameters are set usually by the regulator, and they are not being calculated internally by the bank. And the final one is advanced internal ratings-based approach. Using this approach, banks can leverage their own internal statistical models in order to estimate key risk parameters like, for example, probability of default, loss given default, and exposure of default. And these internal models usually allow for a more tailored and granular assessment of the bank's risk profile in comparison, for example, to the standardized approach. And the use of internal models is a key differentiator here of the advanced risk-based approach, as it enables banks to more accurately reflect the unique risk and its characteristics. So the next one is standardized approach to the market risk, which is being also provided by the Basel III Accord. So first of all, it uses predefined risk factors and correlations. And according to the internal models approach, banks can use their own value at risk models as well. And also the internal models approach includes requirements for stressed value at risk, which also aims to capture tail risks better than traditional value at risk. And for example, recent revisions of the Basel Accord have introduced the fundamental review of the trading book, and it significantly actually changed the market risk capital requirements. For example, this new approach aims to address weaknesses revealed during the 2008 financial crisis, including, for example, the need for a more coherent boundary between the trading book and the banking book. Then the standardized approach to market risk provides usually a consistent and controlled way to measure and manage different types of market risks. Not only the price risk, for example, it usually includes specific markups for exchange or forex risk, interest rate risk, commodity, and derivatives risk, and so on. This approach also separates accruals for total and for specific interest rate risks, and provides a more granular way to observe these important risk factors. So let's talk about the value at risk for the total risk estimation. Here, all positions in the portfolio are usually included in the value at risk model. And here, the risk factors considered are those related to total market risk, and they are used usually to determine diversified capital requirements. And the specific markups applied are similar to those used in the standardized approach. And the goal here is to provide a comprehensive view of the total market risk exposure across the entire portfolio. So then stress testing is a really crucial part of the risk management strategy, because it allows to understand how our portfolio would perform under extreme market conditions. Here we usually closely track specific risk drivers like individual stock prices and credit spreads, and this can have a significant impact on our overall market risk exposure. And here, accurately separating total and specific risks is very essential for ensuring we maintain adequate capital and meet regulatory requirements. So the key focus of the slide, as you can see, is on more rigorous requirements of the value at risk, or for the value at risks. So they may include, for example, stressed value at risk, which calibrates the value at risk model to suit these stress conditions rather than just normal market conditions. Risk not in value at risk, or RNIV, which expands the coverage of the value at risk model in order to include more comprehensive set of risks beyond what is traditionally included. And then total revaluation. So this approach involves a full revaluation of the portfolio rather than just approximation. So let us consider the counterparty credit risk, which is the risk, as you can remember from the credit risk model, that the risk that the counterparty to a transaction could default before the final settlement of the transaction's cash flow is done. So, and Basel III provides several approaches to the counterparty credit risk calculation. The first one is standardized method, current exposure method, and internal model method. So these methods differ in their complexity and risk sensitivity. For example, current exposure method is the simplest but the least risk sensitive. And internal model method, for example, allows banks to use their own models, but it requires regulatory approval. So the current exposure method, or CEM, is used to calculate a counterparty's exposure default. And here, exposure default is usually calculated based on the asset's mark-to-market value, percentage of the par value to account for potential future losses. And it is adjusted usually, it has an adjusted value of any collateral. So it is adjusted for the account of collateral, in other words. So CEM method focuses on the current exposure to counterparty, and it considers both potential future losses and the value of collateral. So then goes counterparty credit risk related approaches. Internal model method. It involves using an internal model to estimate an expected positive exposure for a given counterparty. Then this calculation is done at the counterparty level, taking into account netting across different products. And the model also accounts for full records on collateral and conditions for additional funds or deal liquidation. And usually this comprehensive approach provides a robust way to measure and manage counterparty credit risk. So let's come up to the next topic of the lecture, of the current lecture, which is economic capital and its calculation approaches. First of all, economic capital is an internal measure of the capital which a bank needs to support its risk-taking activities. And unlike regulatory capital, which is based on regulatory rules, economic capital is based on the bank's own assessment of its risks. And here, economic capital aims to cover unexpected losses with the very high degree of confidence level. It's typically 99.9% or higher. And then it's calculated using complex statistical models that simulate thousands or millions of potential loss scenarios. And also, economic capital can be more risk sensitive than regulatory capital and is often used for internal capital allocation and risk-adjusted performance measurements as well. So the question is, how is economic capital calculated? First of all, it starts with understanding the difference between expected and unexpected losses. Expected losses here are those we can statistically predict based on the historical data. and these are typically covered by the pricing and provisions. And unexpected losses are potential losses beyond the expected level, and economic capital is designed here to cover all of this. So the calculation here involves three key risk parameters like probability of default, loss given default, and exposure default. And expected loss here is calculated, as you can remember, by multiplication of the PD, LGD, and exposure default. And then economic capital is calculated to cover losses beyond this expected level up to a certain confidence level. And it involves actually a complex statistical model and Monte Carlo simulations to generate, as you can remember, millions of potential loss scenarios. So the target percentile is a very crucial concept in economic capital calculation, and it represents really the bank's risk tolerance. In other words, how much risk of insolvency the bank is willing to accept. This slide, as you can see, shows how different target percentiles correspond to external credit ratings. For example, target of 99.92%, meaning that the bank can survive in 999 times out of 1,000 scenarios. It corresponds to the BBB rating. And so the bank in this example has chosen BBB as a target rating. And so this choice has significant implications because, first of all, it determines the amount of economic capital the bank needs to hold. Then it influences the bank's risk appetite and strategic decisions. Then it affects how the bank is perceived by investors and counterparties. And then a higher target rating means stricter or higher requirements for economic capital as well. So here we can get back to the probability of default estimation for and its connection to the credit rating. First of all, I should remind you that PD is a key input in both regulatory and economic capital calculations, and it's expressed in percentage. So for ease of understanding, PD values are often grouped into buckets. And these buckets usually correspond to credit ratings. For example, a PD of 10% is considered a very high risk, and it might correspond to a low rating like, for example, B or CCC. A PD of 1% is relatively low risk, and it might correspond to higher rating like BBB, for example. So, but it's important to note that PD models and ratings are not fixed forever. That is why they undergo regular statistical validation. So LGD here is another crucial parameter in capital calculations. And as you can see here in the slide, here you can see the simplified model for assessing LGD over an economic cycle, which is often called downturn LGD. And here the model considers different recovery scenarios. First of all, recovery through normal business operations, then recovery through assignment or selling of the debt, then recovery through implementation of collateral. And here, each of these scenarios has its own probability and expected LGD. And here, you can see the visual summary of how economic capital relates to the key risk parameters that were discussed before. So here the graph shows the distribution of potential losses for a loan portfolio over time, and the area to the left expected represents the expected losses, or EL, and this measure is covered usually by pricing and provisions. But as you can remember, economic capital is designed to cover unexpected losses. So it is the area to the right of the expected loss. And here the amount of capital, economic capital, depends on the chosen confidence level, which is linked to the target rating we discussed before. And one of the major concepts under the economic capital is the division of the expected loss and unexpected loss. So as you can remember, expected loss, or EL, is the average loss we anticipate based on the historical data, and it's usually covered by the bank's reserves or provisions and pricing. And unexpected loss otherwise is additional loss beyond the expected level. And it itself is covered by the capital of the bank. And the total capital requirements is based on two measures: on the regulatory capital, which is usually Pillar 1 of Basel Accord, and economic capital, which is usually calculated according to the Pillar 2 of the Basel Accord. So here you can see the process of calculating economic capital for credit risk. Like, for example, we can generate random macroeconomic scenarios like GDP growth, oil prices, exchange rates, and for each scenario, we can estimate how it would affect PD and LGD. Then we calculate portfolio losses under each scenario, and we can repeat this process, for example, millions of times, for example, 3 million scenarios. And the result is usually a distribution of potential losses. Here, economic capital is set at the level that covers losses up to the bank's target confidence level. And overall, this process captures both idiosyncratic risk, which is specific to individual borrowers, and systematic risk, which is affecting the whole portfolio. So we have come up by now so far to the final question. Please take a couple of minutes to write your correct answers into the chat. So I do not see many answers. Yeah, you're quite right. So the answer 4 is right, actually. Economic capital is calculated as unexpected losses minus expected losses. Well, first, thank you very much. So let us consider now the RAROC concept. So RAROC usually stands for a risk-adjusted return on capital, and it's usually one of the key metrics in risk-adjusted performance measurement. Also, RAROC provides a way to compare the profitability of different business activities on a risk-adjusted basis. And the basic formula for RAROC is risk minus adjusted return divided by the economic capital. It's in general. So risk-adjusted return takes into account expected losses and operational expenses as well. So here is a formula, detailed formula of the RAROC and its comparison to the ROE, return on equity ratio. Comparing to RAROC, ROE advantages are: it is easy to implement and to understand. Data is readily available from financial statements for the calculation, but it has also disadvantages, like reserves don't always reflect real borrower risk. It's difficult to allocate equity to business units or clients. And RAROC advantages here are that is more sensitive to borrower risks through use of expected loss of the borrower and through use of the economic capital. And it can be calculated and allocated to any level, to, for example, business unit, client, or transaction. And RAROC disadvantages are: it is more complex to understand and to manage, and while RAROC formula, as you can see here, is income minus expenses minus expected loss divided by economic capital. So the ROE formula is income minus expenses minus reserve expenses divided by the content or balance capital, balance equity. And overall, RAROC provides a more risk-sensitive view of profitability, in general, allowing for better risk-return decision. Also, RAROC helps balance the interests of different stakeholders in the bank. For example, on the part of the client managers, they want to maximize income on their bonuses. Risk managers need to objectively assess risk without client pressure, and credit committee members, they make objective decisions considering both profitability and risk. And RAROC formula incorporates all of these perspectives. For example, income components like interest or fees reflects well the client manager's efforts. Then expected loss reflects the risk management's assessment. Economic capital represents usually the overall risk in the bank, which the bank is taking, and so on. So this slide shows how lending units, for example, can improve RAROC through various actions. For example, improving loan security, for example, reduces LGD, it reduces LGD, lowering expected loss and economic capital. Or, for example, growing cross-selling, which increases commissions income without significantly increasing risk, and so on. And the next concept is economic value added, which is another important risk-adjusted performance measure, and it is expressed in monetary units usually, and it shows the bank's risk and capital cost adjusted income. So the formula, as you can see here, is risk-adjusted profit minus the multiplication of the cost of capital by economic capital. In general, it shows whether a business activity is creating or destroying value after accounting for all costs, including the cost of risk capital. And here, positive economic value added means the activity is creating shareholders' value, and negative suggests the activity is destroying value, and it may need to be reconsidered. This is an example of the risk dashboard and risk regulatory reporting here. And here is the final question of the lecture. So let's take a couple of minutes for that. Yeah, great. I can see your answers. So the 4 is right.